High occupancy is not safety when the interest coverage ratio sits at a fragile 1.8 times. LENDLEASE'S global commercial REIT has priced $120 million in perpetual securities at 4.28%, a figure that sits 42 basis points below my minimum yield hurdle. With the risk-free T-bill now verified at 1.47%, the margin for error for high-gearing retail landlords has effectively vanished. And today we are going to audit the debt wall to see if your distribution is truly protected. High occupancy is not safety when the interest coverage ratio sits at a fragile 1.8 times. LENDLEASE'S global commercial REIT has priced $120 million in perpetual securities at 4.28%, a figure that sits 42 basis points below my minimum yield hurdle. With the risk-free T-bill now verified at 1.47%, the margin for error for high-gearing retail landlords has effectively vanished. And today we are going to audit the debt wall to see if your distribution is truly protected. Looking at the broader market snapshots, the STI level is sitting at 5,017.66. More importantly for yield seekers, the latest 6-month T-bill auction for April 26, verified under code BS26107X, has landed at 1.47%. We are also seeing significant regional volatility in North Asian markets, which is driving a lot of defensive positioning into SGX-listed yield plays. In this environment, verifying your benchmarks is the only way to stay safe because the risk-free rate is the foundation upon which all our yield spreads are built. If the foundation moves, the whole house of cards can shift with it. Now let's look at the audit results for LENDLEASE'S global commercial REIT. This is a triple alert situation involving gearing, interest coverage, and yield trap warnings. When we look at the metrics, the PERP yield of 4.28% fails against our threshold of 4.7% or higher. The gearing is at 38.4%, which is well above our 35% ceiling. Most critically, the interest coverage ratio is at 1.8 times, failing the required floor of 4 times. Occupancy is the only metric holding up at 95%. But as I always say, high occupancy is not safety when the financial plumbing is this strained. Breaking this down through the 5-layer audit, we see that the 4.28% yield is significantly below the Iggy minimum yield hurdle. When we look at the peer context, we can see that Suntec REIT is also struggling with elevated gearing above 40%. However, there is a key difference here. Suntec has a much larger asset base which offers more divestment levers. LENDLEASE'S global commercial REIT has a portfolio that is very heavily concentrated in Orchard Road assets like 313 at Somerset. This concentration means they have fewer places to hide if the retail market in that specific corridor starts to soften or if financing costs stay elevated. What does this mean for the forward scenario and your wallet? If we see even a 10% rise in financing costs, that 1.8 times interest coverage ratio will compress toward 1.6 times. That is the danger zone where you risk breaching bank covenants and being forced into a dilutive equity fundraising. For a 50-year-old investor living in Ang Mo Kio who is managing their children's university funds through SRS and CPF SA, this counter is a clear yield trap. The current yield simply does not compensate you for the gearing risk you are taking on, and a cut to the distribution per unit is a high probability event if rates stay higher for longer. The market is currently cheering this PERP pricing as a sign of bank support, but the forensic reality is much grimmer. An interest coverage ratio of 1.8 times leaves almost no breathing room. If occupancy at 313 at Somerset or GEM dips even slightly, the math for the distribution starts to break down. We are watching a manager trying to fix a balance sheet by issuing debt that is cheaper than previous tranches, but it is still more expensive than what the underlying property yields can comfortably support. Let's be honest, lowering the coupon only buys time. It doesn't solve a solvency issue. Shifting our focus to Frasers and Neve, we have a yield trap alert here as well, but for different reasons. The raw fact is that F&N is investing up to 15 million Singapore dollars in a New Zealand honey producer called Comvita. They are trying to pivot toward resilient demand categories. However, the dividend yield of 3.77% still fails to clear our 4.7% hurdle. While it is technically above the 3.2% forensic floor, it does not offer a sufficient risk premium over the 1.47% T-bill. It is a strategic move, but the numbers don't quite add up for a sanctuary play yet. In the forward scenario for F&N, a 10% drop in consumer discretionary spending across Southeast Asia would severely test the claim of resilient demand. The macro trigger to watch is regional inflation, which could dampen household beverage consumption. For a 45-year-old HDB owner in Clementi who is building a dividend portfolio, this is a watch list trigger. The pivot into premium health products like honey is strategically sound, But the current 3.77% yield is not a sanctuary when your CPF SA benchmark is giving you a guaranteed 4.0%. Why take equity risk for a lower return? My insight on this honey pivot is that it is a classic capital rotation play. F&N is moving away from mass market sugar and toward premium health. But we have to be realistic. $15 million is a pilot project, not a total transformation of the company. For this to change my forensic stance, F&N needs to prove that honey margins can actually offset the rising logistics and raw material costs in their core bottling business. Until that happens, the yield is not enough to clear the hurdle. A tactical pivot is interesting, but it is never a guarantee of a stable dividend. Turning to Yangzijiang Maritime, we are looking at a strategic neutral stance. They have secured $89.8 million in vessel leasing agreements for 13 vessels, with terms ranging from 1 to 8 years. For a 65-year-old on CPF Life living in Toa Payoh, this update provides some cash flow visibility, but the shipping sector is inherently volatile. This is not a core sanctuary asset for a retirement drawdown. The long-term leases are a good floor for revenue, but they don't necessarily raise the ceiling for the stock in a way that makes it a must-buy for a conservative portfolio. If you look at the analyst chatter, several institutional houses are calling this debt refinancing a de-risking event because it improves liquidity. But my forensic filter sees it differently. Liquidity and solvency are not the same test. A yield that sits 42 basis points below our 4.7% hurdle does not pass our safety standards, regardless of how the banks or the analysts frame the refinancing. We don't care about how much cash is in the door today if the long-term interest costs are eating the walls of the building. We look at the solvency of the distribution first. Let's look at the watch list and the yield spread. The Lendlease Global Commercial REIT PERP yield is at 4.28%, while the 6-month T-bill is at 1.47%. That gives us a risk premium of 2.81%. However, my minimum yield hurdle is calculated by taking the 3.2% forensic floor and adding a mandatory 150 basis point risk premium, which brings us to 4.7%. That floor does not move just because the market has a temporary dip. We keep the standard high to ensure your sanctuary assets can withstand a return to long-term average interest rates. The window is already open. In this volatile market, the difference between a sanctuary and a yield trap is often decided in a single trading session. By the time this forensic analysis reaches a free subscriber, the entry window I identified has already opened, and in many cases, it has already closed. This is why timing and data integrity are the only things that keep a retail investor from becoming the victim of a market shift. If you are waiting for the news to confirm what the data already showed, you are already too late to the trade. Stop being exit liquidity for the institutions. When the setup is live, you need zero-day forensics and red zone watchlist to protect your capital. This is about having institutional-grade cheat sheets at your fingertips for less than the price of a kopi and kaya toast at Raffles Place. For $9 a month, you move from guessing to knowing. Before we go deeper, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds and it tells the algorithm that data-driven SGX analysis deserves to exist. The bottom line for Lendlease Global Commercial REIT is that this is a management win but an investor warning. With gearing at 38.4% and interest coverage below 2 times, the safety margin has evaporated. It remains a yield trap for those chasing Orchard Road prestige without auditing the debt wall. For Frasers and Neve, the 3.77% yield still fails the hurdle despite the smart long-term hedge into honey. And for Yangzijiang Maritime, it is a solid update that reinforces the floor but doesn't change the neutral forensic stance for now. If we look at a neighborhood pairing for a resident in Pasir Ris, you are essentially choosing between a risky retail landlord and a slow-moving beverage giant. In the current environment, neither of these offers the sanctuary that a 4.0% CPF SA return provides right now. When you compare the risk of a 40% gearing level against the guaranteed return, the choice for a heartland investor should be clear. We are not here to gamble on prestige. We are here to protect the principal and ensure the cash flow is sustainable for the long term. The red flags were always there. We have to summarize the forensic stakes. Don't let a 4% yield trick you into accepting 40% gearing risk. In a world of 1.47% T-bills, the forensic floor exists for a very good reason. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access link in the description. The window is already open, and for those who didn't audit the debt wall, the red flags were visible long before the distribution was at risk. Check the link below to join the elite tier and stop being the exit liquidity. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.